I'm going to go through a couple of different things. Um, First, what I'm going to talk about today is just give kind of a quick corn and soybean outlook. And then Rebecca had a question after our last meeting in August on carry in the market. So I'm going to try to provide a little bit of clarification on what exactly carry in the market is and how producers can use it as a method to get a higher selling price for corn or soybeans. And I'm going to use numbers that some in the futures market and some that are specific to cash prices in Clarksville. So I'm going to take a look at those types of circumstances that people can use to end up generating a little bit more money. So first of all, again, the market update, we're seeing a shift in market focus to domestic consumption. So exports and use for both corn and soybeans. And then again, on a demand or on a production side, the focus will be on the South American crop as we move to the end of 2017 and into 2018. So again, soybeans, we've seen that continued volatility in soybeans. We've been reasonably consistent in corn, but we are going to continue to see some of that volatility in soybeans as we have more revealed about the South American crop. Obviously, with only having the three major market participants on the production side, it does lead us to be more cognizant of changes in the weather and production as we end up moving forward. So a couple of just real quick notes to start out on soybeans. We're estimated to have record production in Tennessee. This has depressed the cash prices and weakened basis across the state. Again, basis is that futures, cash price minus futures. So if you have a negative basis, you're getting a lower price in the futures. If you have a positive basis, you're getting a higher price than the futures. And I got a couple of slides that will kind of highlight that point. There is good news in soybeans. Global demand has remained very strong. Export sales pace is a little bit behind last year, but it has quickened in recent weeks. So that's a real positive for prices. Brazil did start out a little dry and has recently received some favorable rains, and there is some additional precipitation in the forecast. But where it does have an impact potentially is it might be since planting has been delayed. There might be an impact on their second crop corn plantings. They might pull back on some of that acreage. So that's something worth watching. Another one, and this speaks more towards exports. The U.S. dollar has strengthened since mid-September. So when you have a strong U.S. dollar relative to another currency, it'll end up providing headwinds for exports. So again, if you see that U.S. dollar continuing to creep up, what it's going to do is it's going to make our exports more expensive relative to other countries that have a weaker currency. At the same time, Brazil in the last month has had a weaker currency. So again, it's one of those ones where they've sold a little bit more beans on the market. Again, they're off season right now. They're just wrapping up their planting season. So again, they're forward contracting those, but again, it is something to continue to monitor because export business will shift between the U.S. and Brazil based on strength of those relative currencies. Soybean use, again, for soybeans, the export market is the largest share of soybeans at 2.25 billion bushels. So again, what happens with those currencies and the global economy in general is really going to drive soybeans. The other positive that I didn't mention on that slide is there are some new growth estimates out there for the global economy that would be very supportive to commodities in general. So again, that's something worth watching. If we do end up seeing some of these growth numbers in that high 3 range that are currently being projected, it would be very positive for agricultural products and corn and soybeans, obviously. I did show this one at in-service, but I did want to reiterate this. We are still in a set of circumstances where we have increased acreage dramatically of both oil seeds and grains, and soybeans has been a big driver of that. The primary reason, again, is due to the fact that soybean meal and as a protein source has been a driver in production because there's a demand on the back end for some of these emerging markets that have changes in diets. You look at where soybeans produced, you can see the green areas are where production is, and they're kind of weighted by crop conditions. So you can see we had reasonably favorable crop conditions in North America. Down in Brazil, you're just getting into, so we're mostly out of season. For Argentina and Brazil, we do have some plantings, but the conditions down there have been reasonably favorable. China, we don't think of them more on the production side, but they do produce a substantial amount of acreage. It's just that their consumption far exceeds what their domestic production is. There are some warning signs, some dry areas in India, and there was some struggles in Eastern Europe. But again, you're talking about such a small amount of production in Eastern Europe that it's not going to really affect overall global production all that much. If you look at imports or soybean importers, there's obviously the three different commodities. So again, if you look at raw soybeans, China far and away largest market at 64%. Soybean oil markets, India is one that's a real interesting case, and I think there's a tremendous potential in India to end up providing soybeans and soybean oil to that market. It is, again, an incredibly large population base, and it's one that has really got the potential to end up having substantial growth. So having some additional exports, not just oil, but potentially some raw beans or meal is something that could end up being a potential if you're looking at a long-term time horizon. If you look at meal, the EU is actually the largest importer of soybean meal, but again, you got a big group of countries that make up a substantial portion as well. I did mention China. If you look at the substantial growth they've had in soybean meal and soybean oil exports from 2000 to 2017, there are risks when you're exporting most of a product to one source. However, given this tremendous growth and the continued expansion of primarily meats, but proteins into that diet, they're not going to reduce this substantial in the near future. They just don't have the domestic production to end up going down that road. So it is a risk, but it's one where I don't foresee a major disruption from a Chinese source as far as reducing the amount of soybeans they import. They will tweak where they are sourcing those from, so whether it's South America or the U.S. But again, if you look at global soybean production as an enclosed system, if you do take more from South America, that means that bean is not coming or not being available to other participants in the market. So again, there's going to be some give and take, but at the same time, I think demand for soybeans is going to remain very strong. Global production, consumption, and ending stocks, we've seen production exceed consumption, and therefore we've seen a build in those stocks. Although in 2017, a lot's going to depend on how the U.S.'s domestic crop ends up finishing out in terms of total production, and also what goes on in South America. If you look at what prices have done, we've kind of been hovering just underneath. It's a blue line is 2017, just right underneath $10 on the futures market. So we've seen a lot of this volatility where we've seen tremendous price swings. If you look back in early July, we were down around $9, shot up to $10.50, then took another step back. I foresee that probably is going to still continue to end up happening as we move into the South American growing season. There's going to be maybe some potential for a supply disruption there. The other one that's going to be really closely watched is going to be what's going to happen in those export markets. This is where it is quite a bit different than in the recent past. So the gray bars here are the 2013 to 2016 soybean basis. So again, that's the cash price minus the futures price. What you can see is that in 2017, the beige bars, we've had a negative basis. So we've been actually under what those futures prices were on that past slide. So the easiest way to end up interpreting this is if you take your 2017 estimate on a monthly basis and your 2016 estimate, say for July, where they're roughly the same at $10, middle of July. In 2016, you're getting 30 over, so 10.30 a bushel, whereas in July you were getting 9.90. Again, this is a function of the large acreage that we have and then the record yields. So I expect basis to be somewhat depressed as we continue to move into September, October, November. And then as we end up entering December, I think we will see a seasonal increase in that basis, but I think it won't get back to positive territory in 2018. Move to corn. Really quickly, there's a new USDA report that's coming out on Thursday, and there's a lot of anticipation that they're going to increase corn yields again by about a half to a bushel per acre, which does make a substantial difference in what the production level is, and then also what on potential ending stocks are. So we could see, if this is realized, the market's likely got some of that priced in. If it's greater than that, we could see additional softening of prices. If it's lower than half bushel to 1 bushel, we could see some potential increase in prices. Export sales prices for corn have actually really lagged last year, which is a concern. Part of that is the recent strength in the US dollar. The other issue with that is there's just still a lot of corn out there, and there is some competition from South America. I mentioned that the later planted soybeans in Brazil may reduce that second crop corn planting, which does have direct implications for the amount of corn that South America will potentially produce this year. So that bears watching. For those that aren't familiar with the South American system, they typically start planting, roughly around September, but most of it is October, November. December is when they plant their soybeans or corn, their full season corn. But they do end up double cropping corn behind soybeans in February usually. So if you don't plant those soybeans until later on in the year, you might forego that opportunity to plant the second crop corn, which would be harvested in August, and that has direct implications on global supplies. Again, what we've seen is we've seen a decrease in profitability from corn. We've seen increased production, reduced returns over the last 5 years, and that's again a function of lower global prices and large amounts of grain out there. If you look at corn use, the 1.85 billion worth of exports, when you're talking just over 14 billion bushels. Again, it's an important medium, but again, we do have other sources to end up utilizing corn. Now, we do have to always remember that there's going to be a big chunk of this ethanol production that's going to result in byproducts that you're going to end up competing directly with feed and exports as well. So even though we're not exporting the same percentage of our production as soybeans, it is still a very important market for prices, because it kind of takes the upper end of our stocks off. If you do look at where we are, where we're projected to be, we are still seeing that stocks growth, and that stocks growth is going to continue to be a little concerning. This is days on hand, where you have back in 2006 we had 42 days worth of reserves. Right now we're projected to have 60 at the end of the year in the U.S. I mentioned world acres. Again, this is one of the key issues, is that you get a rapid increase in the amount of acres, 100 million acres added. That was roughly a couple of years ago what we were planting in corn. So you're adding a substantial amount of production, and it's gonna probably flatline. It's not really going to take a big step back. You look at corn production across the globe, and again, you have a much more diversified production base. China's a major player in corn production. They aren't in the export market because it's all consumed domestically, but you do have places where you see corn production that you're not going to see soybean production. So again, it's much more of a global production system. The U.S. is still the dominant player in corn production, but at the same time, it's a much more diversified production base than soybeans. Again, if you look at where we've been globally, we've had production exceed consumption. Although in 2017 we are anticipating, or the USDA is anticipating, that we will have consumption higher than production. Part of that is reduced production compared to last year's records in the U.S. And the other one that I mentioned briefly is that strength in global economies, right? If you have increased economic activity, you see higher consumption levels of most commodities. So again, that's a benefit to the commodity complex when you end up having a strong global economy. And again, if we do see this little decrease, 2007 or 2018 crop, we could end up seeing some more beneficial pricing opportunities that are currently right now. December futures are just below $4, between $3.90 and $4 a bushel. So again, looking at some opportunities on the December contract when it gets above $4 might be not a bad place to start some pricing for producers. You look at, these are 2017 corn futures, but we've seen them move substantially lower after that little bit of a weather scare. But again, what I would anticipate for 2018 is that we're going to trade somewhere around that $4 range until we end up getting new information from South America, or we end up getting closer to that planting season domestically. Again, you get a similar basis response where we are seeing a deeper decline in basis relative to what we've seen in the past years for corn. And again, a lot of that is driven. We've had just tremendous yields in Tennessee, which from a net revenue standpoint is good. But when you're dropping that price down, it does highlight the importance of being able to get that extra, 5 cents or 10 cents per bushel, because if you have 180 bushel corn or 200 bushel corn, 5 cents a bushel or even 2 cents a bushel makes a big difference to those bottom lines. So again, one thing that I do always want to encourage, this is a snapshot in time. So we always want to be cognizant of if information changes. This is from a famous economist. When my information changes, I alter my conclusions. So if something were to happen with trade in particular, or domestic policy, or a weather anomaly in South America or another production region, it's very important to go back and reevaluate what is going on in those markets. And if there has been a change in direction or a change in the underlying fundamentals, it's important to incorporate that into a marketing plan. So again, I've touched on most of this, but looking at these key factors as we move into 2017 for old crop, and then as we move to new crop, it's going to be planted acreage and relative prices, relative yields, and costs of production. That's going to influence what we plant in the U.S. South American weather is going to be very important. This macroeconomic conditions, I think, is really got the potential to end up providing some price support. We'll see if that does materialize as we move into 2018. But those are the types of events that are going to end up really driving major price changes. There's going to be short-term noise in markets, as there always is, but looking at some of these big drivers that could really push prices one direction, another is one that I think is going to be very important. So now I'm going to shift up a little bit here and for a couple of minutes just talk quickly about carry in the market. So again, what you're looking at is the price difference between two different months and whether that costs or has enough value in it to end up covering the cost between two contracts. So in a simple example, if you have a March 2017 futures price of $3.50 a bushel, and the cost of carrying, so storing and some other costs, all costs in is 10 cents a month, and the May 2017 contract is trading at $3.70 a bushel. So you have 2 months, that's 20 cents. Then it's said to be a full carry, or in other words, the contract represents the full cost associated with holding corn for 2 additional months. If there is no difference, if the difference between the two contracts is less than the cost of carrying, then there's no incentive to store or carry it. If the difference between two contracts is greater than the cost of carry, then there's an incentive to store. It's very important to adequately estimate those carrying costs, including your interest, your risk premium, handling, and storage. And it can be applied to both futures and cash markets. And I'll show a quick example of both. So if you have carry in the corn futures, I printed this off as of I believe Monday, but you have the 2017 December contract, and then all the contracts for 2018. For those that aren't familiar with the futures markets, you don't have a contract traded each month for each commodity. It varies by commodity. So corn, annually you end up having 6 contracts that you can end up trading. So you're looking at the price differences between these months that have contracts. So again, if you look December to March, it would be 348 and 361. There's 13.5 cents total carry, or 4.5 cents per month. March to May, again, you've got a fewer number of months at 8.75, so you get a monthly carry of 4.3 and a quarter. And again, you can see how these are calculated. So what you want to look at is this carry amount. Can you carry corn for less than 4.5 cents from December to March, or March to May? And you can add these cumulatively if you're storing them for longer time periods. Switch to soybeans, same general principle. So you're looking at the difference between January and November is 10 cents. You got 2 months there, so it's 5 cents per month, and diminishes over time. It's not a huge opportunity right now in the futures market, but where you do see some benefits, these are cash prices. This is specific to Clarksville, so this is the numbers that are reported by AMS for the elevators and barge points near Clarksville, Tennessee. So you can see soybeans, if you have a cash or spot price, right, the price that the producer would get right now going into an elevator, you have a November spot price of $9.26, but you have a January cash forward contract of $9.66. That gives you a carry of 40 cents or 20 cents per month. I think there's an opportunity there if you have availability of storage to end up making some money, because again, this is likely to exceed what your cost of storage is. Commercial storage can be tricky in parts of Tennessee. You have to be careful with that. But again, what you're looking at is these two price differences. And it's very similar to doing a forward contract during the production year. The major difference is most of the time the crop's already been harvested, right? So you don't have that production uncertainty. So if you were to cash forward contract something in June with a November harvest date, you have a tremendous amount of production risk. Whereas when you've already harvested and you're storing it, you know what the quantity you have is. What you really need to figure out is what's your cost to end up storing that. And to end up looking at that, what you really want to end up looking at to evaluate the carry is you need your 2 different delivery dates. I picked November and January for the cash one, but they can be a combination of any different time periods, and then prices for both delivery dates. Then you have to look at your cost of carry. So storage, obviously grain bins are not free. You will need to recoup the investment on those bins and any airflow systems that would be associated with that. And then also there's interest, right? If you don't sell that crop and you're paying interest on an operating loan, it's easy to calculate what's foregone. But even if you don't, there is an opportunity cost of not realizing that income. So if you're not borrowing, you could end up investing that money for 1% in an alternative. You do want to account for that foregone alternative. Then again, risk premium. What happens if the crop is damaged in storage? You have to account for shrink, those types of things. So when you're trying to get this, what you want is your all-in cost. Just to end up sitting there and saying, well, what's my added storage cost? You need to consider some of these other costs as well, because they are costs that will reduce the amount you're getting, or the amount that you have to end up putting into that crop. The other example is handling. If you're going field direct to market, that is a different cost structure than if you're going field to storage to market. So again, you want to evaluate those types of alternatives as you move, as you look at the cost of carry between 2 different contracts. Last slide that I'll show here is we have our 2018 Zoom meeting dates: March 7th, June 13th, August 22nd, November 14th. We are keeping the same time. I think it's worked out well. We are open to suggestions on topics and other things like that. So again, that's something where we really appreciate everybody's participation, and we want to make sure that we continue this into 2018.